Welcome to Tesla Deep Dives. The pivotal topic on our agenda today is the valuation paradox, why TSLA's stock price defies tanking deliveries, and the triumph of the AI investment thesis. Good evening, and welcome to our deep dive into the market's most fascinating contradiction, the Tesla valuation paradox. In 2025, Tesla's vehicle deliveries saw their first prolonged annual contraction, with full-year figures estimated at 1.64 million, an 8.3% decline from the previous year, and the company officially lost its title as the world's top EV seller to China's BYD. Yet, despite a Q4 2025 delivery miss and a brutal 36% stock plunge earlier in Q1, the stock ended the year with a respectable 16% gain, and in January 2026, shares climbed over 4% on another delivery miss. How does this disconnect happen? The answer lies in the triumph of the AI investment thesis. The tanking deliveries context is stark. Q1 2025 deliveries hit 336,681, a painful 13% year-over-year decline, and a miss against Wall Street's adjusted consensus of approximately 377,592. Management attributed this to planned Model Y line changeovers across its gigafactories in Texas, Fremont, Shanghai, and Berlin. Compounding the issue were aggressive price cuts to fight foreign competition, pressuring automotive margins, and the expiration of the U.S. federal $7,500 EV tax credit, which pulled forward demand into Q3 2025. Traditional valuation metrics scream bubble. The stock trades at a rich valuation, hovering near 268 to 310 times non-GAAP forward earnings, while peers operate at a fraction of that multiple. However, the market's reaction to bad news is muted. After the Q1 miss, TSLA shares were down only 1.87% at $263.43 per share, a move that analysts described as better than feared. This resilience signals a great recalibration, where the stock is increasingly valued as a diversified technology and energy play, not a cyclical car manufacturer. The core of the bull case is full self-driving and the subsequent robo-taxi network. The launch of Tesla's unsupervised FSD ride-hailing pilot in Austin, Texas in June 2025 was flagged as a major inflection point. Analysts project that a commercial robo-taxi network, charging between $1 and $2 per mile, could generate up to $15 billion annually by 2030, turning Tesla into a massive software-as-a-service giant. The dedicated autonomous vehicle, the Cybercab, is slated for mass production in 2026. The AI narrative is grounded in Tesla's technological ecosystem. The company has committed a reported $5 billion investment into its AI infrastructure, centered on the custom-designed Dojo supercomputer. Dojo is not just a tool, it's designed to create a closed-loop system that continuously trains the neural net using the 50 gigabytes of real-world driving data collected daily from every Tesla vehicle, an unmatched competitive moat. Bullish reports suggest Dojo could add up to $500 billion to Tesla's enterprise value. Furthermore, Tesla is focused on its custom AI chips, moving toward a new chip design to volume production every 12 months. Beyond the car and the software, the biggest long-term bet is the Optimus humanoid robot, which CEO Elon Musk has claimed has a market potential larger than the car and FSD businesses combined. Tesla set targets to build roughly 10,000 Optimus robots in 2025, with an aggressive ramp to 50,000 units in 2026, initially for its own manufacturing lines. The investment thesis views this as industrial automation, with applications far beyond the automotive sector. Wall Street remains fiercely divided. Bullish analysts like Wedbush's Dan Ives, who once called the delivery numbers a disaster on every metric, quickly pivoted to reiterate a buy rating and a massive $551 price target, declaring, "We believe Tesla could reach a $2 trillion market cap over the coming year." Deutsche Bank is also leaning into the robot taxi AI narrative with a $500 target. Skeptical voices, such as UBS, maintain a $247 sell rating, arguing the stock is pricing in too much autonomy upside too soon, given the significant regulatory and execution risk. The true paradox lies in this gap. valuing the company on proven fundamentals versus projected SaaS-level profits. Despite deteriorating traditional fundamentals, like the 13% Q1 delivery decline, the narrative that dominates market sentiment is the AI powerhouse thesis. Key to this shift is the energy storage business, which saw record performance and margins in Q3 2025 and 14.2 gigawatts deployed in Q4 2025, providing a fundamental growth cushion while the automotive business struggles. The market has successfully redefined Tesla from an EV king to a speculative barometer for the future of artificial intelligence and robotics. The next phase of the paradox will be decided not by Model Y volumes, but by key AI-centric metrics. Investors must monitor the FSD take rate, the percentage of owners who buy or subscribe to the software, the regulatory timeline for the unsupervised robotaxi launch, and, most critically, the progress and scale of Optimus deployment beyond internal use. Finally, a significant decline in the PE multiple without a corresponding drop in the stock price would indicate the market has officially re-rated Tesla into a true AI software stock, making the 2025 delivery slump a mere historical footnote. Let me know what's your thoughts and leave your comments. Thank you for joining us for this crucial deep dive. To ensure you never miss a pivotal analysis, please like the video, subscribe to the TSLADeepDives channel, and hit the notification bell. Your engagement fuels our critical research.